Hi, I'm Mark from Property Ventures. Welcome to this week's New Zealand Property Podcast, where we interview the property expert around New Zealand. Right. So welcome back to this week's podcast, and welcome back, Kris Pedersen.
Thank you, Mark.
You haven't been on the show since we now have a camera in front of us, so now people are going to know not only what Kris Pedersen sounds like, but what Kris Pedersen looks like.
Bringing technology to the game.
Lucky them.
Definitely.
Okay, so we're here, those who don't know, Kris has Kris Pedersen Mortgages, and he has a team on both sides of the bridge, and deal with investors all around the country and overseas, I guess.
Yeah, property traders and developers, especially that type of the market.
Okay, right, the one thing that has probably helped slow the market down in the last year or so have been the bank's lack of lending or having money to give to people. So has that loosened up at all at the moment, or what's the latest?
I mean, pretty much the market tightened almost 12 months ago, I suppose. We saw the 40% deposit restriction coming for investors, and that's definitely what's the media, I suppose, is mainly concentrated on.
Yeah.
But almost about the same time, we saw the banks really start to tighten their own criteria outside of that. They went from, I suppose, what we saw the previous few years, where they were throwing cash out to almost anyone who had a pulse, to pretty much feeling like you have to give your firstborn away to qualify. And a lot of that had to do with restrictions that were coming out of Australia. Also, I suppose, with the way that the banks fund, they fund through wholesale funding money, effectively getting cash from offshore, and then retail funds, I suppose, people putting money into bank accounts, etc. And we're kind of banging up. We don't really have actual limits in New Zealand. They have limits in Australia where they can actually lend about 25%, or sorry, about 25% of their total funding can come from offshore. Right. I believe the New Zealand market at the moment, about 31% of our funding's offshore. So that's been seen to kind of be on the high side. So there's pressure on the banks not to be really doing too much more wholesale funding, meaning they're having to focus on the retail funding side. And with interest rates being so low, that's limiting, I suppose, the amount of cash which is getting put in.
Yeah.
And I was looking at a article that the ANZ chief economist did about a month or so ago, and he did quite a good graph illustrating that the demand for credit is a lot more than the availability of credit. Right. And so it comes down to, I suppose, the same way that we run a household is, at the end of the day, if you've got more going out than you've got coming in, you're going to run into problems. Right. And so that's a lot of what is actually kind of caused this restriction.
So the banks are actually being very picky with actually who they're giving money to, because it's either them or them. They can only give money to one of them almost.
Completely.
So you actually can fit the criteria but still not get the money.
Exactly, and that's definitely been one of the challenges we found being a broker. Is we probably prided ourselves on being able to look at someone and go, you'll completely qualify for this mortgage now. Where we've found a lot of times over the last 12 months it's been a bit more hit and miss. Right. Not even just with the bank, but with the actual individual banker. You can almost have the same application going on a Monday to a Friday. One might get approved, the other one might almost get declined. Yeah. And so it's definitely a bit all over the place at the moment.
It's tough on you. And,
yeah, it
doesn't make you look good sometimes when it's not your fault.
Yeah, and so a lot of it's basically trying to explain to clients that the environment has changed. Things like revolving credits and that, we've always looked to get large facilities in place for clients, try and remove the bank controlling their situation as much as possible, and that's an area which has definitely got a lot harder, and in most cases we almost can't do it. Yeah,
I know it's sort of taken a year, but most people seem to be aware now that the banks aren't lending money, and even our vendors that used to be they used to think that they wanted too much for their property, they're now realising that there is a battle with getting lending, so that's good.
I mean, it is a case of it. There is still money out there, but it's a time where people have to make sure they're ticking all the boxes. Things like having dishonours on your bank statements or missing a mortgage payment, in the times where money's a bit more flush, the banks will probably tend to turn maybe a bit more of a blind eye to that. Yeah. At the moment, if you're giving them a reason to turn the application down, they'll grab that. Absolutely. So you want to be really clean in regards to the way that you're looking, so we can present it in the best possible way to a bank.
Yeah. So keeping all that in mind, you maybe covered half this already, but so what challenges are some of your clients having right now? Or is that yet?
I mean, the LVR restrictions obviously have affected a lot of people, especially in markets like Auckland, where we've obviously got pretty high average house prices, and so 40% for a lot of people is quite a large amount of capital. Yep. We've noticed the unitary plan came into play. A lot of people have been looking at that, and unfortunately though, that's kind of an area where it's actually got quite hard to fund.
Yep.
So doing that kind of situation of maybe kind of cutting 1 into 2 or 1 into 3 tends to be fine.
Yep.
We're finding a lot of the banks, when you're trying to go past that 3, they're being quite difficult to deal with.
Why is it? Is that just because of the monetary side of it, or there's the risk factor, or what?
We're finding in some cases the banks are starting to go, well, that's kind of going, depending on the bank, that's going outside normal residential into we're going to classify it as commercial.
Okay.
Or some banks are going, we're even going to send this off to the property finance unit. Now, the property finance units really should only be handling things like, I want to build a 10-storey apartment block or a big commercial building or something like that.
Okay.
But we've seen a couple of the banks are bringing the property finance units in a lot earlier, and I've got a couple of the PFU guys actually as clients, and they've been saying behind the scenes they're really doing that to get us to kind of find a reason to decline the application,
right?
Because they're trying to actually kind of pull back their lending. And this is my opinion, it could be wrong. I think it's again the banks looking at the amount of credit they have to supply and going, well, we'd rather spread that around a number of borrowers than maybe giving it to one developer at the moment. Because if we spread around a number of borrowers, we've obviously got more of an ability to sell credit cards, insurance, other products on the back of that to a multitude of people than having this capital locked down maybe by one person for a period of time.
Okay, makes sense. Okay, people are out there listening here and they're thinking, is there anything, it's hard to get lending, is there anything they can do to be more prepared before they even come and see you, or before they look at a property, or
it's definitely a time to be pre-approved. We've always said that you want to be ready, that the best investment deals, you often need to be in a position to move very, very quickly. Time is of the essence. And so that doesn't really change too much, what part of the cycle you're in. But I think in particular now, there's a lot of people who may not have looked to try and get funding for 12, 24, 36 months, and they're expecting the environment is still relatively similar, and they're quite surprised when they're finding a lot of things have changed. So to me, it's a really good time to look at maybe kind of having a bit of a lending review so you can really understand the way a bank's looking at you. What we try and do when we have a consultation with a client is try and kind of show you your strengths and weaknesses from a bank point of view. Obviously, the way that you run numbers is important when you're looking to buy an investment property, but the way the banks actually look at the numbers behind the scenes is actually quite different, especially on the servicing side. And the way that that's probably a big change we've seen lately as well. I've had a couple of clients, I think it was last week, who both had, from a equity or a gearing point of view, are very strong. Both had pretty similar profiles with about 8 mil of property, $2 million of debt, and they'd dealt with a bank, their whole life got declined, and they were surprised. And both of these clients, I could probably say 2 months ago, I could have quite easily got another $1 to $2 million of borrowing.
Right.
But because of changes in the way that the servicing is being assessed, these people are failing with every single bank now. Okay,
so don't assume you know how much you can get from the bank at the moment. Get prepared first before you start looking.
Completely. It's a really...
More so now than ever.
That servicing side's a big change, and this leads into things I think like there's obviously been a fair bit of media coverage around the debt to income restrictions that the Reserve Bank would like to jam through. And while I think a lot of borrowers are going, well, they haven't been put in, things haven't changed, my impression is that the banks themselves are trying to be seen to be more prudent by self-regulating and making their servicing harder, in the hope that will maybe deter the Reserve Bank from actually being able to implement debt to incomes.
Okay. Well, good. We'll talk more about that shortly. But and we had one client about a month ago where they were confident as of getting their finance. They still put the finance clause down, of course, and then within 3 days they were told there's no way you're going to get finance for the property. So and there's not, despite how the market is, there's actually not a massive amount of property out there. There's still the sort of shortage, as well as the prices have got some sort of stability, even though good places and good areas seem to be still going very well, and I'm experiencing that right now.
It's been interesting. For a little while it seemed that things were quite slow, I think, in the lead up to the election, but I've actually had 2 conversations with 2 reasonably active investors in the last 24 hours who've both said that they've noticed stock really starting to move, simply because there's so few actual options on the market. I don't know what the reason is, but there's certainly been no slowdown, and we're getting more buyers now than we've actually seen ourselves. So we've definitely seen quite a few of the more experienced people have come back in. I think cases like 12 months, 24 months ago, when it wasn't worth going to an auction because you were going to probably have 10 people in front of you who might be paying too much for the proproperty. If you've got good buying rules now, you can kind of go along to maybe a number of auctions, and there's vendors out there who have to sell. So we've seen some people who've actually managed to pick properties up at really good prices.
Great. I was going to hit you up with elections and get all some politically incorrectness going on here about who we favour and who we don't favour, but we won't. But I believe you are putting a blog out in the next week or so about elections. Is that about elections and the effects of who?
It's just going to be a bit of a general blog. I mean, I will say this on here. I got an article through from Bernard Hickey in the last week, and Bernard's kind of known for not being a big fan of property, but he did actually kind of make it pretty clear on his article, going for those who are probably, property investors, he'd be going, you'd be wanting to vote National. He goes, the other parties, especially more to the left, are more likely to come out with rules which are going to, hit the property market, a whole lot harder, and that includes things like kind of regulating. There's a lot of talk, and we're seeing things like the New Zealand Herald really try and put the poor renter up on the front page and make stories up about that. So I expect to see a lot more regulation in regards to landlords and making all that harder as well.
I do know, I sort of mentioned to you just before the show here, I mean about 8 or 9 years ago, when not long after National got in, I was quite involved with the Property Investors Association and seeing the work Andrew King did on behalf of the property investors with the government, and the government were bringing all these, National at that stage, were bringing all these new policies in, and they didn't really have the effect of what that meant for the end user, which is the tenant.
Yep.
And they thought they were helping the tenant and crucifying the investor, but as it turned out, they were just making the tenant pay more.
Yep.
And probably if there's one thing I will say is what I'm afraid the government changes is they'll have to go and re-educate that whole new government again.
Yep.
Where it took National a few years to do it, but actually they I think they have an overall a good picture of how that is. So yeah, Bernard Hickey's probably right with what he's saying, I guess. With that. Anyways, enough of that. We won't get too hung up on the elections. We'll see what happens in about 6 weeks' time. So crystal balling ahead with this interest rates. They've still stayed, reasonably stable for a long time now.
Trying to pick interest rates is really hard.
People have given up on it, I think. It just stays low at the moment.
Most of the economists have kind of at times suggested they're going back up. I think we saw with, this was about October last year leading into the US elections, I think, with the markets freaking out about the whole Trump situation, we saw interest rates, spike for a while then. And I think while we're never quite going to get used to Trump and the tweets and everything else that kind of goes along with him, the market probably has settled down a little bit with that, and we've actually seen interest rates maybe trend a little bit lower. I think a couple of the banks there, jammed interest rates up a bit, but they really stopped lending. And I know earlier I said that they wanted to cut back, but some cut back too far and almost completely stopped. So with them becoming almost uncompetitive, they realised that they had to kind of start pricing a little bit better. We've had pretty much again for the last 12 months, the banks have been tending to price owner-occupied and investment pricing very differently. So throwing cash contributions out for owner-occupied lending, still giving good rate deductions on that side. In most cases, not giving any cash on the investment side, and in a lot of cases, not really any type of deductions on interest rates. We've seen a couple of banks actually kind of get back into that market where they've been throwing quite chunky cash out again and good rates. We had a couple of deals in the last couple of weeks. One was about a $2.3 million mortgage where the client got given $16,000 in cash. Another one was 1.5, 1.5, and they got $11,000 in cash, and this is all investment property.
Right.
So there is a stage at the moment where even if you're maybe not looking to buy, but you're wanting to maybe lock in, good rates, there are big differences in regards to what is being offered at the moment. So if you may be looking to kind of consolidate your position, right now there are some good deals around depending on the bank you're dealing with though.
Well, it's good to hear sort of things. That's been the main deterrent for a while. And moving on from interest rates is obviously the LVR rules. We know I think we've talked enough in the last year about the effect that's had on business, and particularly within property investors, and the slowdown with that on top of the banks not giving money. But I want to add something with LVR, but more importantly, tell us about DTI also.
So I think we've obviously seen situations like I think it was the Barfoot's chief, and we saw the Real Estate Institute and the Property Institute all kind of come out and say, look what it's done, LVRs have done to the market, they need to be retracted. And I think both Bill English and Jacinda kind of almost alluded to that as well. The RBNZ governor, I think it might have been his exit speech, because he's leaving the job, has made a few comments in the last couple of days, and he's very much kind of saying they're not going to be going anywhere in the short term. This is, again, just my opinion. I wouldn't be surprised what the Reserve Bank ideally would like to do is probably bring in something like debt to incomes and then maybe relax the LVRs at the same time, especially in that kind of first home buyer side of the market. But on the DTI side, I mean, that scares the hell out of me. That has the potential to completely shut the market down if it was brought in, I think, on the way the Reserve Bank would like to. So they released a consultation document probably the best part of a couple of months ago, which is worth a read for anyone who, you know, is wanting to invest as an investor and is interested in property in general. And they basically laid out all their, you know, case for why a DTI should be introduced. They reference a lot of countries overseas which have maybe, you know, brought DTIs in. There's another couple of documents which are worth a good read. There's a guy, Ian Harrison, who runs a business called Tail Risk, and another guy who runs a blog called Croaking Cassandra, and his name's, I think, Mike Riddle. Both of those used to be senior RBNZ employees,
right.
So they're bright economists, and both have come out slaughtering DTIs. Ian Harrison in particular, basically his document is reviewing the Reserve Bank, their consultation paper,
right.
And he just pulls holes all through it.
Okay.
So as an example, the Reserve Bank wants it applied to property investment as well as owner-occupied, and part of their argument was referring to the Bank of England, who brought DTIs in. He basically goes, well, actually the Bank of England only applied it to owner-occupied lending, they haven't applied it to investment lending.
Okay.
So there's quite a few holes in there. They're good holes he's pulled in the case. He also correctly references that if you look at the way that DTIs work, they're taking into account in most cases, if I buy a home, you know, for my own occupied you know, use, and what DTIs are doing is taking living expenses into account. But then if I go to decide to buy another property as an investment, well, my living expenses don't apply to that property.
Right. Yeah.
And the same, you know, as each property goes on, which is why things like the Bank of England have actually excluded investment property.
Right.
Which seems to make common sense to
me. It does. It seems to make sense for the home buyer, the only property they're going to have, because it's hugely important they can pay it back, and they you can service that for a long period of time. So it probably does have some logic there. But
and there's also what's known as like debt servicing ratios. Now the Reserve Bank really makes it sound like there's all of these countries which have bought in DTIs, and Ian Harrison correctly slaughters that and says a lot of the countries haven't actually bought in DTIs, they've bought in NSRs or DSRs, which I won't get into too much here, but they're quite a different way of assessing servicing than what DTIs are. So again, it was a massive flaw in the Reserve Bank document. So it's hard to see exactly where this goes at the moment. The Reserve Bank, I think, is going to try and keep pushing their case. I think both major political parties were never going to let it come in or, you know, be seen to be recommending it before the election. I think with how unpopular it would be, I'm hoping both would fight against it after the election, and the government that's in and the Finance Minister and Treasury have to approve it. So I'm hoping with these other consultation documents, which make really valid points, that will keep DTIs out for a fair while to come.
Especially with investors, geez.
Yeah. I sit there and go, again, you know, DTIs may work in some of the smaller regions in the country. I just don't see how they could be applied in Auckland. We're supposed to have a supply issue here, and what we're going to do is we're going to turn off the ability to get funding for a huge amount of people.
When you learn a little bit about it, and from a simple man's perspective, I guess as I said, the DTI for the home buyer sort of works. The LVR restrictions, if you want to slow down the investor, it's worked in the last 12 months, and it's certainly there's people worked their way around that, how they can deal with it. But, you know, have them each for apples with apples and not oranges and pears.
Completely. I mean, I just believe that the Reserve Bank's job is to control inflation and to look after financial stability of you know, the banks and the finance companies, etc. And I think they're kind of overstepping their lines here in regards to it's not their job to kind of control the whole economy. What they should be doing if they're concerned about the financial system is make the banks hold more capital, which would basically, you know, strengthen the whole banking system. But if you loosened up things like the LVRs and didn't implement DTIs, then at least we'd be in a situation where more people can get finance. That's going to make it easier to, you know, I think, provide supply, build more houses, etc.
Absolutely. That's the issue they've got they're trying to fix. So great stuff. Well, you're a man of great knowledge there, Kris. And if you want to get hold of Kris, go to Google Kris Pedersen with a K for Kris, and he has his own blogs, what have you, on his site, as many of you listening here will know. What some might not know is Kris also's wife and runs a property management company out of the same building you have your mortgage brokerage, called Kris Pedersen.
Oh, it's Pedersen's Property
Pedersen's
Management.
Property Management.
Yep.
Sorry about that.
That's okay.
And just tell the listeners, I think you've had you just won an award recently. You can tell us briefly about that, and also where do you cover with your property management?
So we pretty much cover the majority of Auckland. We probably specialise mainly in like the shore, central, kind of eastern suburbs. That tends to probably be where we've just ended up with most of our properties, but we do have properties across all of Auckland. It was a pretty pleasant surprise on Friday night. We won small property management company of the year through REINZ, and one of our property managers got nominated for property manager of the year as well. So that was a nice surprise, and that's quite, I suppose, beneficial, because we get to see a lot of the inside workings from not just being a landlord myself, but also in dealing with lots of landlords basically through that business. That, when combined with the finance side, it's an interesting market, put it that way.
Yeah, absolutely. I must go along to the awards night. Might be a good night, Kris.
Definitely, it was.
All good. Okay, any parting comments? Anything you see coming up in the future before we wrap it up?
I'd just say I think it's a time where you can't sit there and bank on, maybe the capital growth we've seen in the last few years, but I think this is very different to, I've seen some doomsayers who are coming out and going, we're going to go, this is like the GFC where the property market's going to maybe kind of come back a long way. The fundamentals are completely different. We've got very low unemployment rates. We've still got high immigration coming in.
Yep.
We're not going to build enough houses. To me, this is a really good time to make sure you've got good buying rules though, and are sticking to those buying rules. If as long as you're sticking to good buying rules, there's some really good buys starting to be around, and things like the New Zealand Herald are going to continue to tell you that tell the average person that the property market's all falling apart when it's actually not, and that's good because it actually kind of creates more buying opportunities for most people.
Absolutely, no, great stuff, and great tips, and totally agree. This is different than the two cycles, and part of that has been a lack of lending for investors over the last 12 months.
Yeah, definitely.
So great stuff. Oh, pleasure having you back here, Kris. And
thank you, Mark.
We might get you back again 6 or 8 weeks after the election and see how things are then, if we're still smiling or not.
And hopefully some things might be freeing up a bit by then.
Absolutely. Good work. Thanks very much, Kris.
Thanks, Mark.